When it comes to financial reporting requirements for renewable energy projects, there are several commonly asked questions that arise in order to ensure compliance with relevant accounting standards and regulations. Financial reporting requirements for renewable energy projects may vary depending on the jurisdiction and specific accounting standards followed. However, this is a general overview of common reporting requirements and measures to ensure compliance with accounting standards and regulations. First, accurate and transparent financial statements, revenue recognition, cost classification, regulatory compliance, impairment assessment, and lastly, other accounting standards and guidelines.
There are several financing options available for renewable energy projects, each with its own costs and benefits. However, the costs may include interest payments, collateral requirements, and stringent loan covenants. Equity financing, which involves raising capital by selling ownership shares in the renewable energy project to investors. Equity investors may include private equity firms, institutional investors, or individual investors. Capital is provided in exchange for an ownership stake in the project. Costs and benefits may vary depending on the tax equity structure, but the most common ones are partnership flips, inverted leases, and sales leasebacks. Next is government incentives and grants from the Department of Energy. Governments often offer incentives, grants, feed-in tariffs, tax credits, or other financial support mechanisms to promote renewable energy adoption. However, availability in terms of public financing can vary depending on the jurisdiction and specific programs. Power purchase agreements, or PPAs, are another option. Under a PPA, a renewable energy project developer sells the project's electricity output to a buyer, such as a utility or corporate entity, at a predetermined price over a fixed period. The buyer provides upfront capital or secures financing to develop the project. Benefits include stable revenue streams, long-term contracts, and reduced exposure to electricity price volatility. However, costs may include negotiating complex contracts, managing offtake risk, and potential curtailment of project revenues if the buyer defaults.
Revenue recognition is a crucial aspect for renewable energy companies, especially when it comes to long-term contracts such as power purchase agreements or PPAs. To ensure compliance, companies refer to accounting standards such as IFRS 15 and ASC 606. These standards provide guidance on how to recognize and measure revenue from these contracts. Renewable energy companies may have significant investments in assets like wind farms, solar installations, or hydroelectric facilities. Accounting standards such as IAS 36 and ASC 360 under GAAP provide guidance on assessing the impairment of these assets if their carrying values are no longer recoverable.
Absolutely. Given the focus on renewable energy and sustainability, companies in this sector often have reporting obligations related to their environmental and social impacts. They may utilize various frameworks for sustainability reporting, such as the Global Reporting Initiative and the Sustainability Accounting Standards Board standards. These frameworks help companies disclose relevant information about their environmental and social performance.
Yes, renewable energy companies can benefit from various tax incentives or credits related to their operations. Specific tax regulations exist for the renewable energy sector, such as investment tax credits or production tax credits. These incentives can have accounting implications, particularly in terms of recognizing and measuring deferred tax assets or liabilities.